My name is Alan Ellman. I'm president of the Blue Collar Investor Corp. And welcome to the Hyatt Regency Convention Center here in Chicago, and to all those listening to this webcast live around the world. Today's topic, we're going to talk about how to select the best options in both bull and bear market environments. One of the mistakes that retail investors make when they trade options is they always trade the same type of options. Now, as it relates to the strategy I'm going to talk about, which is covered call writing, most retail investors only sell what's called out-of-the-money strikes, strike prices that are higher than the current market value of the stock. And the reason they do that, and it does make sense, because it gives us the opportunity to generate two income streams in the same month with the same cash, one from the sale of the option and the other for any share appreciation from current market value over here up to the strike price if it's higher over here. However, there are certain market conditions that dictates not using the out-of-the-money strike, but using the in-the-money strike. So I'm going to make a case for that today. We're going to start with the basics because I know a lot of you are beginner options traders. So we'll start with the basics of options trading, and we'll work our way up gradually to both hypothetical and then real-life examples. I'm going to show you how to incorporate the options chain information into a calculator that I developed. People are calling it the Ellman calculator, that will do all these calculations for you, that will help give us guidance as to which strike price to select and to how to manage our trades. At the end of the presentation, I'm going to go over some of the products. I'm going to spend about 2 minutes on this. Some of the educational products that I have available to take your returns from over here to up here. My 7th book was just published last week. So we're going to go through that. And then at the end, I'm going to show you all the free resources on the Blue Collar Investor website. And if we have time at the end, I'll take questions. If not, we'll step out of the room for the next speaker, and I'll hang out as long as you need me to answer any additional questions that you may have. Now, no matter what strategy you're using, you have to be able to talk the talk. So we're going to start with a few definitions. There aren't a lot. To those of you experienced as options traders, this material you already know, but don't worry, there's going to be something for everybody in this presentation today. So we're going to start with the very basic, what is an option? Well, an option is a contract that gives the buyer or holder of that contract the right but not the obligation to buy or sell 100 shares of the underlying security. Now, that underlying security could be a stock, or it could be an exchange-traded fund, an ETF. You could use either when you're writing covered calls. Now, a call option, which is what we're going to be talking about today, gives the holder or buyer of the option the right but not the obligation to buy 100 shares of stock at a specified price, known as the strike price, by a specified date, known as the expiration date, and most options expire 4 p.m. Eastern Time on the 3rd Friday of the month. Now, as covered call writers, we're on the sell side of options, and that's what we're going to be talking about today. We're going to be talking about selecting the best options when you're on the sell side of options. So a call option gives the holder the right to buy. Therefore, we are obligated then to sell our shares at the strike price by the expiration date. That is the obligation we're undertaking, and that is why we get paid a premium for undertaking that obligation. Now, a put option is the opposite. It gives the holder or buyer of that put option the right but not the obligation to sell 100 shares per contract to the option seller. So we're not going to be addressing put options today. If you have questions regarding selling cash secured puts, I'll be happy to take them after the presentation outside. Now, the next three definitions are the option strike price. That's the price we are agreeing to sell our shares for. as it relates to the current market value of the stock. The first definition is at the money, and that's where the strike price is the same as the current market value of the stock. So let's say, for example, we buy a stock for $30 and we agree to sell it for $30. That strike price is said to be at the money. Now, if it's off a little bit, let's say it's $29.92 or $30.12, that 30 strike is said to be near the money. It's almost the same thing as at the money. So when you hear the term near the money, that means almost at the money. Now, an in-the-money strike, which is almost never used by a covered call writer. I mean, 99% of covered call writers only use the out-of-the-money strike. But I'm going to make a case today why you should be considering in-the-money strikes in certain market environments, and I'm going to make a promise to you. And that promise is, if you learn how and when to do this, it's going to put cash in your pocket. I've been using this strategy now for more than 20 years. And when I've used the in-the-money strikes appropriately, it's always mitigated losses and enhanced gains. So it's made me a better covered call writer, which is what I want for you. Let me give you an example now of an in-the-money strike. We buy a stock at 56 and we agree to sell it for 50. Now, intuitively, most beginners would say, that's crazy talk. Why would we do that? We're losing $6 on the stock before we even start. Well, the answer is the premium that we generate when we sell that in-the-money 50 call is going to compensate us for that $6 loss in the sale of the stock plus a little bit more. And it's that little bit more that represents our initial profit. I'm going to break that down on the next slide. So when we sell an in-the-money strike, if we count the entire premium as profit, we will have grossly exaggerated our returns, which makes no sense. So that amount that we're going to lose on the sale of the stock has to be deducted from the premium to get a fair assessment of what our initial time value return is. Now, for those of you who are a little challenged when it comes to math, I'm going to start off with some good news. I've developed a calculator that will do this math for you. And at the end of the presentation, I'll tell you how you can all get a free copy of the basic Elman calculator. So do not worry about the math. The takeaway here is, when we sell an in-the-money strike, buy a stock at 56, agree to sell it for 50, we cannot count that entire premium as profit because it's not. I'll break that down on the next slide. Now, the third term, as the strike price as it relates to the stock price, is out of the money. And this is the one that 99% of all covered call writers all over the world use. Example, you buy a stock at $48 a share and you agree to sell it at $50 a share. It's higher than the current market value. Now, why is this so appealing? Let's say we generate $1.50 for the sale of that 50 call, $150 for the contract, minus small trading commissions. Well, we've generated $150 into our account right at the get-go. And now we have an opportunity to make $2 more, $200 for the contract if the price of the stock moves from 48 up to or higher than 50. Now, if it goes higher than 50, as covered call writers, we cannot participate in that share appreciation because of the contract obligation to sell at 50. And therein lie the main disadvantage of covered call writing. We can only participate in share appreciation up to the strike price. However, when that happens, when you've generated premium and when your stock price has moved up to the out-of-the-money strike, you have had one hell of a return that month on that particular trade. And you'll see the math broken down from real-life options chains once we plug it into the calculator. I have two more definitions. You could see at the bottom of this screenshot the equation that we as option traders all should know. The premium that we generate when we click the button on our computer to sell that option consists of intrinsic value plus time value. So those are the two terms I'm going to describe for you now, intrinsic value and time value. Intrinsic value is the amount that the strike price is in the money. Therefore, it only applies to in-the-money strikes. The example I gave before was buying a stock at 56 and agreeing to sell it at 50. So in-the-money strikes have an intrinsic value component. At-the-money strikes, buy a stock at 30, sell the 30 call, or out-of-the-money strikes, buy a stock at 48, sell the 50 call, do not have an intrinsic value component to them. Therefore, the premium is 100% time value for at-the-money and out-of-the-money strikes. Now, let's get back to the in-the-money, because this is the one where I'm going to hope that I can get you to consider in your covered call writing portfolios in certain market conditions. Now, let's say we generated an $8 premium after buying a stock at 56 and selling the 50 call. We know right up front we're losing $6 on the sale of the stock, most likely. We're losing $6. So if we got $8 on that premium, we have to deduct that $6 from the $8 to get our actual time value profit, because that's what time value is. It's the premium minus intrinsic value. In the case of at-the-money and out-of-the-money strikes, it's all time value. You don't have to figure anything out. That's it. That's the time value. So in this case here, if we got $8, $6 is intrinsic value, not profit. $2 is time value. That is our initial profit. Now, when you're using this strategy, before you risk even 1 penny of your hard-earned money, there are 3 skills you must master. And we're going to talk about one of them today, but I'm going to identify all 3 of them. The first one is stock selection. What underlying security are we going to use in our covered call writing accounts? Now, if you have a long-term buy and hold portfolio and you're writing calls to generate, let's say, another 6-8% a year, that's a different story, because those are the stocks you're going to use. Those are the ones that you have. But in a traditional covered call writing portfolio, like I use and I have been using now for over 20 years, your portfolio is going to turn over because you're going to reassess your bullish assessment on that stock on a regular basis. So let me just give you one thing you should not base your stock selection on. One of the biggest mistakes that retail investors make, and that is which stock is going to return the highest premium. Take that and throw it out the window, because the higher the premium, the greater the risk in the underlying security. Now, how do you know how volatile the stock is? That's easy. Calculate your return. If it's more than 6%, it's a very volatile stock. We're talking about for a near-the-money strike and a 1-month return. My goal when I set up my trades in regular normal market conditions is 2 to 4% time value 1-month returns for near-the-money strikes. In my mother's more conservative portfolio, where I use ETFs, it's 1 to 2%. So based on your personal risk tolerance, that will dictate which strike price you should select, in the money or out of the money. Option selection is the topic for today's presentation, is the second required skill, and the third one is position management. All of these are super important. So you figure out what stock you're going to get. You figure out what option you're going to sell. Now you're in the trade. What do you do if the price of the stock goes way up? What do you do if it goes way down? What if there's an ex-dividend date that may cause the option buyer to exercise the option to capture that dividend? What do you do if the strike is in the money as expiration is approaching and you don't want your share sold? All that has to be figured out ahead of time before you enter your trade. So once again, do not risk even 1 penny of your hard-earned money before you've mastered those 3 required skills. Now let's focus like a laser onto option selection. All right, there are 2 categories here with option selection. The first one is what expiration, how far out should we go with our options? And the second one relates to the moneyness of the option, in the money, at the money, out of the money. Okay, so those are the two choices that you have with the option. Now, number one, set your goal. What do I want to achieve for my initial time value return? Now, that doesn't mean you're going to end up with that at the end of the contract, but you have to have a starting point. You have to be structured. I told you mine is 2 to 4%. I'll go up to 6% in a raging bull market. I'll never go higher. I'll lower it down a little bit in a bear market, maybe go to 2 to 3%. My mom's account, maybe I'll go to 1 to 1.5%. But the strike price that you select should have a goal set up so you have a framework to know what option you're going to select. Now let's start with expiration dates. Now I'm going to tell you right up front, my sweet spot, 1 month options, pure and simple. I've tried them all, shorter term, longer term, 1 month options. And you do have other choices though. Many stocks now have weekly options associated with them. And we have members of the blue collar investor that do like to use weeklies. There are pros and cons. I have had my success with monthlies. Now, monthlies compared to longer term options will always, you could check this with any stock, any options chain, any day of the week, any month of the year, will generate higher annualized returns than longer term options. Yes, longer term options will generate more initial cash, but if you then annualize those returns, the monthlies will beat it. Now, people that do weeklies think that their annualized returns are going to be greater than those that trade monthlies. That may be the case. I'm not convinced of it yet, but it's possible, and that's why some folks like to trade weeklies. Longer term options, even as far out as 2 years with leaps, long-term options can go 1 to 2 years out. A leaps option is more than 9 months, up to 2 years. Now, they will generate lower annualized returns. They will cross over multiple earnings reports. And one of the biggest rules in the BCI methodology is to never, ever sell an option if there's an upcoming earnings report. Longer-term options take you through multiple earnings reports. And also, monthlies will allow you to reassess your bullish assessment on that particular security on a more regular basis than a longer-term option will. So that's why I like monthlies. The examples you're going to see here, I think I have a couple of 6-week options, so to annualize those, you would multiply them out by 8.5. Now, let's talk about the moneyness of the strike, and this is really the key to today's presentation. The in-the-money strike, buy a stock at 56 and agree to sell it for 50. That has the advantage of protecting you to the downside because, well, let me make this statement first. Here's the reason why we as covered call, right, and I love talking to retail investors because I've had an opportunity for my family to benefit from this strategy for over 2 decades, and I'm sharing this information with you. Why is covered call writing a strategy that allows us to beat the market on a consistent basis? And the answer is very simple. When we sell that option, we are lowering our cost basis, period. We're getting cash back initially. Click that computer tab and the cash is in our account. Our cost basis is lowered. Okay, now, I did say that the disadvantage is you can only participate in the upside up to the strike price. Okay, so that would be the disadvantage. But initially, we're starting out by lowering our cost basis. When we sell an in-the-money strike, we're lowering our cost basis more than an at-the-money or an out-of-the-money strike because it has an intrinsic value component to it. So we're lowering our cost basis even further. Now, we cannot participate in share appreciation at all with an in-the-money strike. That's the trade-off. So you're probably starting to see now, what kind of market environment would I go within the money? Well, bearish, volatile, pre-Brexit, pre-election, pre-Fed watch, whatever makes you nervous, tariffs, whatever's going on today, we can craft our portfolio by using in-the-money strikes to give us that additional downside protection. Now, what if the market is humming along nicely? It could be a neutral market. It could be a bull market. Then you go with the out-of-the-money strike that gives you the opportunity for two income streams in the same month with the same cash, with the same stock. One from option premium and the other from share appreciation from current market value up to the strike price. So, to review why I like monthlies, you get greater annualized returns than using shorter-term options. You have ample opportunity for exit strategy execution. On weeklies, something happens, you barely have any time to do anything. You have to take the hit. Monthlies have better liquidity in most cases than weeklies. That means the bid-ask spread is smaller, which means the price executions that we as retail investors get is going to be much more favorable to us. It's much easier to avoid earnings reports. In a stock for this month, in a stock for this month, here comes the earnings report, see you later, stock leaves our portfolio, bring it back the month after earnings. Now, if we have weeklies with that particular stock, we could sell weeklies maybe 3 out of the 4 weeks of that contract, just skip the week of the earnings report. And again, it allows us to reassess our bullish assessment. All right, let's make some money. Here's an options chain, real-life options chain, 6-week returns on Alexion Pharmaceuticals, ticker ALXN, which was trading at 144.08 when I made this screenshot. Now, you look at the bid column. For those that have never looked at an options chain before, you'll see a bid and an ask column to the right of that. The bid column, when we sell an option, we sell at the bid, the lower amount, and if we bought an option, we'd buy at the ask, the higher amount. The difference is known as the spread, and that's pocketed by the gazillionaire market makers. All right, now, that said, and this is not part of my presentation, but I'm happy to address it at Q&A either inside or outside. There are ways that we as retail investors can negotiate better prices with the market maker guys, okay? And for those of you who have my books and DVDs, if you look at the section that relates to the show or fill rule, I explain how to do this. So in this particular case, for Alexion, the 140 in the money strike, it's lower than current market value of 144.08. You see a 770 to 880 bid-ask spread. I guarantee you I would have gotten more than 770 by leveraging the show or fill rule. Guarantee you. But for purposes of this presentation, I'm going to use worst case scenario, and we're going to use the published bid, which is the lowest amount that you would get. The out-of-the-money 150 strike, higher than current market value, generated 320. Okay, here's a little snippet of the multiple tab of the Elman calculator. On the left side, the blue cells, you feed in the information from the options chain. You could see Alexion was trading at 144.08. The two premiums I alluded to before, 770 for the in-the-money, 320 for the out-of-the-money. The strikes were 140 and 150, and they expired on the same date. So these were 6-week returns. Now, let's look at the 140 in-the-money strike, the one that we would use in a bear market, volatile market, any market that you're concerned about, where you want that additional insurance policy to the downside. And by the way, the term insurance policy is interesting because it does give us protection to the downside, more so than the at-the-money and out-of-the-money strikes. But it's the one insurance policy in our lives that we don't have to pay for. That policy is paid for by that guy over there who bought our option, the option buyer. All right, so the in-the-money, the calculator will deduct the 408 intrinsic value from the 770 premium, and it will let us know that the return on our option 6-week is 2.6%. So annualized out to, let's say, 20%. Now, upside potential, too bad. We sold an in-the-money strike. We have an obligation to sell at the strike price. It can go to $1 million. We have to sell at 140. However, downside protection, this is not break even, ladies and gentlemen, downside protection of the time value profit, 2.8%. That means we are guaranteed a 2.6% 6-week return as long as share value does not decline by more than 2.8% by expiration. Stated differently, as long as the price of the stock does not decline from 144.08 to below 140 by expiration. In a bear market or volatile market environment, I want that protection. Maybe somebody else doesn't, I do. Now, what if it's a neutral to bull market? What if things are humming along pretty good? Well, I want an opportunity to generate two income streams in the same month with the same cash. How do I do that? I sell the out-of-the-money 150 call, which generates a 2.2% initial time value return. That's 320 divided by 144.08. That's the formula in that cell. But we have an opportunity for an additional 4.1%, and that represents the upside of 592, right? 592 divided by the cost basis of 144.08. We have an opportunity in this particular 6-week time frame to generate a 6.3% 6-week return. And that, you see, then, is why an out-of-the-money strike in a neutral to bull market environment will benefit our portfolio the most. In the opposite market conditions, the in-the-money strike will benefit us the most because we've lowered our break-even further down. Now, if you look at that break-even column, you see the in-the-money strike, 136.38, is the break-even. You'll always get a lower break-even with the in-the-money strike because of that intrinsic value component to the option premium. Here's another example. Control 4 Corporation, CTRL. Was trading at 24.89 when I made the screenshot. We're going to look at the 22.50 bid of $3. Once again, I would leverage the show or fill rule, see if I can get another 5 or 10 cents. But we're going to use $3. And the out of the money 25, it's kind of near the money because it was 24.89. I would call that near the money, 25 strike, generated $1.50. So here we are once again in the calculator. And you could see that the in-the-money strike, when after deducting the time value, the intrinsic value of $2.39 from the $3, that leaves us a 2.7% 6-week time value return, 2.7%. Not bad, because you multiply that by 8.5, and that'll annualize it out just so you get an assessment. Upside potential, once again, too bad. Downside protection, wow, 9.6%. That means in order to start eating away at that initial 2.7% initial time value profit, CTRL has to drop by 9.6%, by more than 9.6%, right? Stated differently, it has to drop from 24.89 to below 22.50. Otherwise, we will have realized that 2.7% 6-week return. Now, what about the out-of-the-money strike? Remember, we always have potential for higher returns with the out-of-the-money strike. Well, in this particular case, since it's a near-the-money strike, it's a whopping 6% 6-week return. And we have an opportunity for a tiny bit more, a 0.4% if it moves up from 24.89 up to the 25 strike. So we have an opportunity here for a 6.4% 6-week return. So once again, one size does not fit all. I can't tell, we have members from 89 countries outside the United States, and I can't tell you, across the whole world, covered call writers only use the out-of-the-money strike. And you can understand why, because you have that chance for more money. But you have to reassess every month what's going on in the market. You know, because the in-the-money strike may benefit us more in August, and then we might go back to the out-of-the-money strike with the September contracts. So reassess. It won't take you that long. And by the way, another thing, if you're selling multiple contracts on the same underlying, let's say you're selling 5 contracts on Apple. There's no law that says they have to be 5 all out of the money or 5 all in the money. I borrowed the term from the bond market, laddering stocks, laddering options, laddering strikes, and you'll see it in my material. So for example, let's say you're slightly bullish on the market, but you're not quite super bullish on the market. Well, how about 3 out of the money and 2 in the money for Apple? Or I'm pretty bullish on the market, but I still have some concerns. How about 4 and 1? So you could break it up if you're doing multiple contracts. Those using single contracts favor the strike that reflects mostly on your personal risk tolerance and your overall market assessment. And there's one other factor, too. For those of you who read price charts, and that's a big part of the BCI methodology, if it's all bullish, you're going to favor out-of-the-money strikes. And if it's mixed, you're going to tend to favor in-the-money strikes. If it's all bearish, you're not going to consider that underlying. All right? So there are several factors in strike selection. We have one more example here, and this is PACOM, P-A-Y-C. We're going to look at the, okay, it was trading at 74.77. We're going to look at the in-the-money, 72.50, the near-the-money, 75, and the out-of-the-money, 80 strike. Those are the 3 strikes we're going to look at. All right. So now that you've gotten familiar with this a little bit, we're going to go through this part a little bit quicker now. So the in-the-money strike generates a return on our option or ROE of 2.4%. That's time value only with the intrinsic value deducted. 3% is our downside protection. It is not break even. It's the amount that a stock price can go down and still retaining our entire initial time value profit. Okay, now, what about the near-the-money strike? At-the-money and near-the-money strikes always generate the highest initial returns. Every stock, every ETF, every weekly, monthly, whatever option you're looking at. The at-the-money strike always generates the highest initial return, but it gives you little opportunity for downside protection or upside potential. So here we have an initial return of 3.4%, and if it moves up from 74.77 up to the 75 strike, a small 0.3%. So we have an opportunity for 3.7% 6-week return here. Now, the one that can give us the highest return is the out-of-the-money because of the 2 income streams. So in this particular case, the 77.50 strike, I think I said 80 before, it's 77.50 generated $1.45. And that represents a 1.9% 6-week return. But we have an opportunity for that share price to grow from 74.77 up to the 77.50 strike. That's another 3.7%. So overall, we have an opportunity here for a 5.6% 6-week return. Now, you could see that in bull markets, we would benefit by the out-of-the-money strike. And in bear markets, we benefit from the in-the-money strikes. I don't care what anybody tells you. You should not only use only the out-of-the-money strike in all cases. You have to say, what's going on today, and how should my trading be affected by what's going on today? So let's review. I think I have a few more minutes left here. Let me see. 10 more minutes, I think. When to use in-the-money strikes, because nobody does this. Use it in bear and volatile markets, or if there's a particular event coming up. Pre-Brexit, I was using only in-the-money strikes. Pre-election, well, I have to admit, I pulled all my money into cash because I felt that if Donald Trump was elected, the market would crash, and I was wrong. So 3 days later, I put all my money back in the market. So, you know, nobody's a genius, and when you hear people telling you, buy this and sell that, nobody knows for sure. But by doing all the little things, all the nuances, and I didn't learn this, by the way, I didn't learn this by back testing on a computer. I learned it by actual trading. I spent most of my professional career, some of you know this, as a dentist, and this was my hobby. And when I wrote my first book and it went to #1 on Amazon, all hell broke loose and I had to make a career choice. So I sold my practice and I've been doing this now. But there is so many factors, so many parameters that we could use, and each one will throw the odds a little bit more in our favor. What stock to select? Only select the best performing ones, not the ones that give the highest returns. What options to select? We went through that today. How to manage your positions. Most people buy a stock, sell an option, and pray. You know, there are so many things you could do to mitigate losses if the stock goes down, or enhance gains if the stock goes up, or even if it goes down and bounces back. I have a strategy where you could make more than a maximum return. I call it the mid-contract unwind exit strategy. It's in my material. So there are so many things we could do. It's not rocket science. I'm not any smarter than you are. I've just been doing this longer. And I'm happy to share all this information with you. Now, in the money strikes, make sure that it aligns with your personal risk tolerance. Some of you may not be able to sleep at night if your portfolio goes down 1% in a day. Well, you may do in the money strikes all the time, no matter what the market's like. I can't tell you what to do. You know, it depends on how you feel about trading, how much risk you're willing to take. Now, I'm a conservative investor. I'm not a cowboy. That's why I told you I won't go higher than 6%, even in bull markets. And that tells me that my underlyings are not going to be super volatile. I don't have to look up implied volatility. I could tell from the returns. Now, if I were to give you one sentence to summarize the advantage of an in-the-money strike, it's right at the bottom of the screenshot there. Intrinsic value protects time value. I never see that any place, but that's what an in-the-money strike will do. At the money and out of the money strikes, more aggressive covered call writing positions, you should use the out of the money strike whenever you can, but don't use it in dangerous market environments. You should have a bullish assessment of the market. The chart technicals should be bullish and confirming. Make sure it aligns with your personal risk tolerance. I told you that when I trade covered calls in my mom's account, I have a lower time value return that I'm shooting for. It's a more conservative account. I only use ETFs in my mom's account. I use individual stocks in my account because I'm not interested in 1 or 2% a month. 2 to 4% is much more appealing to me. And again, those are initial returns. And of course, again, to reiterate, the out-of-the-money strike allows you 2 income streams in the same month with the same cash. Now, you have the handout, so you see the promo code for the books and DVDs on my website. I'm going to briefly go through them, and then the free resources, and if we have any time for Q&A. Our most popular package is the complete Encyclopedia for covered call writing. I have 2 of them. The classic edition is the one you should read first. It's been #1 on Amazon.com on covered call writing since it was published to this day, along with our most recent DVD program. We have that packaged with a month of free membership. Volume 2, by the way, each encyclopedia took me 4 years to write, just to give you an idea of the time and effort I put into these books. That's doing very well too, but it has not bumped off the classic edition. It was 96 articles that I published after I wrote the classic edition, and I put each article into the corresponding chapter. So if it was an article on calculations, it went into the calculation chapter. Now, my pride and joy is Stock Investing for Students, which once my name got out there, I decided to write the book I always wanted to write. And it's not options. It's basic finance, dividend reinvestment, dollar cost averaging, the difference between mutual funds and ETFs. And it's required reading now at several colleges in the United States, including the University of Maryland, Ramapo College, and several others. So if you know anybody not near retirement, children, grandchildren, whatever, that are interested in learning finance, this may be a book you want to consider. I also have the #1 selling book on selling puts. It's called Selling Cash Secured Puts. That's also on the website. And my 7th book, which came out last week, Covered Call Writing Alternative Strategies. I wrote that with Barry Bergman, who's the managing director of BCI, my right-hand man. And it covers 3 covered call writing like strategies, not traditional. One of them, if you look on the lower right, portfolio overwriting, for those of you who have long-term buy and hold portfolios. There's a specific way you should use covered call writing, not the same way I do with traditional. Okay, thank you. And the second strategy in this book is the collar strategy, which adds a protective put to covered call writing. So buy a stock, sell an out-of-the-money covered call, buy an out-of-the-money protective put, protects you to the downside. For those of you who are ultra-conservative, you want that additional protection at the expense of making less money. this could be the right strategy for you. And finally, at the bottom, you see the poor man's covered call. Just curious, how many of you ever heard that term, poor man's covered call? Okay, some of you, not a lot. Poor man's covered call, instead of buying a stock and then writing a covered call, you buy a long-term leaps option, a year or two out, and then you write short-term covered calls against that long-term position. Now, if you look out there in the informational spectrum on the poor man's covered call, it's defined as covered call writing but cheaper, because you don't buy a stock, you buy an option. That part is true, but there are so many moving parts to this strategy, so many moving parts, that you really have to learn it in detail before you would say, yep, that's the strategy for me. I'm not saying it's not, but I'm just saying there's so much more to it than what you see out there in the informational world now. Now, in addition to those three strategies, I have also created 3 new calculators, one for each of these 3 strategies, in addition to the free ones I'm going to tell you about. These 3 aren't free, but they're on my website and available at the discounted price. So once again, if you go to the website, thebluecollarinvestor.com, don't forget to type in THE. It'll ask you for a promo code. You put in Chicago 20 and apply code, and you'll get a 20% discount at checkout. Now, here are the free resources on the Blue Collar website, and I have them numbered, so let's go through them quickly because we only have a couple of minutes left. Number 1 is a Google search tool. I've written over 400 journal articles over the years on topics related to option selling. You can, if you have a topic that you're interested in, let's say technical analysis, put in technical analysis, use the Google search tool on the website, and it'll pull up all the articles that I wrote on that topic. It's a huge resource of information, and most of them are related to trades that I either made in my own account or that members have sent to me that I thought would be interesting learning experiences. Number 2 is a glossary of terms for covered call writing. You may want to bookmark that. Number 3 is the free resources link that has the basic element calculator, its user guide. There's also a free put calculator that I created in there with that user guide and about 10 more files. Just click on that, put in your email, and you'll have access to download all those tools for free. Number 4 are Ask Alan videos. Over the years, my team suggested that I get a lot of email questions, that I should make PowerPoint video responses to the ones that are most common or the most interesting. So I started doing that, and last time I looked, I had 150 of them. So those are only available to premium members, but we do put 10 or 12 up for free to the general member sites. You can click on that and have a look at those. There are additional training videos that my team rotates. I'm not sure what's up there now, but I'm sure it'll be worth your while to have a look at them. That's number 5. Number 6 is the store, where you have all my books and DVDs and additional calculators. Just have a look around. There's lots of stuff there. You can get a 20% discount on any of those products through the 27th. Now, the Beginner's Corner, number 7, is probably the second most popular free resource on my website to the calculator. And those are 2 8-part video tutorials, one on covered call writing and one on selling cash secured puts. So you could log in, hit that link, put your email in, and then you'll have access to say which one you want, covered call writing or selling cash secured puts, and you'll have access to the videos whenever you want. Do them whenever you want, come back the next day, the next week, or whatever. You can also download the PowerPoints for free. And the final one, number 8, doesn't apply to you guys, but we have members in 89 countries, so the website is available in 80 different languages, which I thought I was being a nice guy when I put that up, but then I started getting questions in languages I had no idea what they were, so I had to learn how to ignore those questions. So let me just see here now. Okay, I'm done. Here's a close-up of that free resources link. Those of you who signed up for my free newsletter, I write an article every week. I spend hours doing it. There are charts and graphs in there. You signed up for it, you don't have to go to the blog link, but if you forget and you want to do it later on, you could sign up on the blog page. I am, ladies and gentlemen, out of time, and I don't want to take time away from the next speaker. So I want to thank you all very, very much for coming. I'll hang out outside if you have any questions. Have a good show, everybody.